Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome, everybody, to another episode of the Creating Wealth Simplified podcast. I am your co-host, Chris Seveney, and today we're going to do a special episode where I'm going to talk about the state of the real estate and mortgage note space. We've just finished the first quarter of 2023, and over the last month, we've seen some significant and very interesting changes starting to evolve. And I want to mention these to investors so they can be out on the forefront of what we potentially may be seeing coming down the pipeline. First is the mortgage note space in general. Many of you know in 2021, 2022, during COVID, just like the residential markets, there was limited assets available for sale. And those that were priced at a premium. Over the last, I'd say 3 to 4 months, we have seen a significant uptick in the number of loans that have hit the market on the residential side. We'll talk about commercial in a minute, but we're just going to talk residential right now, where we had approximately $300 million of assets cross our desk in the first quarter of 2023. And along with that, the pricing standpoint of those assets is also starting to come down. Sellers are starting to realize that the pricing that they could get in 2022, because housing continued to go up, so this deferred interest and this interest that was accruing was matching that rising price. Now we're kind of seeing the tables turn. And what do I mean by that when we say tables turn? Well, when you have a non-performing loan, typically you have costs of taxes that you have to keep paying on the property. The property is accruing interest, but you also have potential other expenses along with your legal. And as long as the properties was maintaining or stabilizing in value or going up, it wasn't a big deal because you realize you could probably get those funds back. But now the pendulum is starting to swing. And what I mean by that is home prices are starting to go down a little bit. And as the equity ratio of these assets, which had equity or little equity, starts to change, all of a sudden you're putting money out that door that you may not recover. And let me give you an example. Let's say you have a $100,000 loan that the property is worth $150,000 and the payoff is $140,000. You're paying the taxes, which could be $4,000 a year. You have insurance on the property. You might have $7,000 a year of holding costs. So you're at $140. Next thing you know, you're up to $147,000 on your costs. That $150,000 asset could be worth now $140,000, where previously that asset could be worth $160,000. It would start to go up. Now it's going down. So holding assets is going to be a negative for these investors who are holding these assets that they're not doing anything with. So along with that, sellers are starting to realize now that buyers realize this and understand where the economy is headed, and they are holding back and pricing things accordingly. There's still some sellers out there who are still, I'd say, somewhat pie in the sky. Perfect example was we looked at a pool of assets recently where we were the high bid, and we're talking, this is over a $1.5 million purchase price. The seller wanted 50% more than the highest bid. It just was not within reality to get to that number. We are expecting that we will see those assets probably in the next several months turn back around, and at that point in time, it might actually be a lower price. So That's one of the things that I wanted to mention kind of in that first quarter. So for people who are investing in distressed debt, I would tell you to be patient. Okay. The assets are starting to come along. We've seen a lot more performing loans in the past several months. We're starting to see now that uptick in the non-performing debt as well. The other thing that really was interesting that we've also seen as we look at the economy in a whole, and before we get into the commercial real estate, is the money supply here in the United States and the banking industry in general. And everybody knows what happened to Silicon Valley Bank and Signature Bank, where they had the liquidity crisis and basically had to run on the bank, and they had to sell off some of their debt that basically caused them to go in the hole. But here's an interesting thing that just recently happened. For the first time, I believe ever, at least back until 1959 when it was recorded, the monetary supply in the United States basically has gone down significantly. As everybody knows, I'm looking at a chart here, our monetary supply went from like 15 trillion up to 21 trillion. So we printed about $6 trillion in debt. That now has gone down by about $500 billion. So as money gets into the economy, of course, I'm not an economist, but if you have more of something, typically leads to inflation. When you have less of something, it leads to deflation, which will potentially lower costs. So tied to that, what I think is important to go along with that interesting component is, and I'm pulling up another chart, which is bank contraction. And there's another chart out there that the banks have contracted by $100 billion over the last 2 weeks. And we have not seen anything like that since, 2008. We've seen a significant contraction like that. And the other was in 2002 during the, the tech, meltdown back then. But if you actually looked at this chart throughout history, basically it's basically a straight line across, and then it has a few blips that go up and down, and those are typically during the highest times of volatility. The reason I talk about this is banks are giving out less money, and we have less money coming into the economy. That means there's going to be less credit out there for people to buy homes, for commercial, which we're going to talk about next. And another interesting segment that recently just happened last week, which is starting to make the news of a multifamily foreclosure in Houston. A syndicator had 4 assets that they had loans over $220 million on that went to sale and foreclosure sale. And everything that I'm going to state right now is my opinion. It's not a fact. I'm not going to name names of the entity. I actually went through and read the loan docs and the foreclosure notices. But first, the syndicator, looking at them, and this is important for people who invest in syndications. The About Us page of the company talked about the CEO's experience in technology and IT. He was an IT contractor. The asset manager was an IT contractor. The investor relations individual had a little bit of real estate experience. And the analysts that they claim or that they had on their website, if you look them up on LinkedIn, they're overseas virtual assistants. This company bought over 2,000 units. For me, having been in real estate for 30 years and have built, managed, and overseen buildings with 500, 800, pick a, large surplus of units. Those are not for somebody that lacks experience. And clearly now, based off of what happens, that's probably one of the main reasons. Another component to this was the type of debt they had. And you're going to hear a lot in the news coming up about bridge debt and bridge financing. And what is that? Bridge debt is short-term financing, typically at a variable interest rate that allows, that comes in and it's sometimes a second position. It could be in a first, but a lot of times it's a second where the sponsor doesn't have the down payment. They'll contribute a portion of it at high debt to get it refinanced out in 3 to 4 years. Unfortunately, what's happened, as everybody knows, 2019, 2021, you could get bridge debt financing for 3 years at rates of, 4%. Those same rates today are at 8%. And based off of the size of those loans, now the debt service is going negative. So you're seeing lack of dividends being issued. You're seeing lack of cash calls. Now, 2008, the crisis was mainly because of giving a lot of loans and people who didn't qualify. The other aspect of it was those 80-20 loans and some of these other loans, which were very low down payment. We're seeing that happen today now in commercial. We're also seeing it in residential on the FHA side, which requires 3.5% down payment. And those loans now have a 10% delinquency rate. The reason why it's important to talk about this commercial is commercial real estate is I think a lot of people who focus on single family don't understand the importance of the commercial market. And a lot of banks, especially small and mid-sized banks, a lot of their lending is on this commercial debt. The residential debt, they can turn around and sell that to a government-sponsored entity like Fannie Mae or Freddie Mac. This commercial debt is debt that they hold. And this low interest debt that they may be holding with recent maturities or these delinquencies is going to put a significant impact on people with liquidity. You're going to see lines of credit getting called. You're going to see credit card reductions. There's talk now about car lots not being able to pull lines of credit for the types of cars on their lots. As the more money comes out of the system, the harder it is going to be to get financing. Now, I will state again, we have our funds in the mortgage note space. We don't take on debt. So we think we're in a prime opportunity with the cash we have to come in and buy this underlying debt. But I just want to, reiterate to people, some of, things we're seeing. 2 examples I will share with you that I thought were very, very interesting that happened just over the past 2 weeks. One is we had an office building note sent to us that the office building today is worth about $5 million. It's a $3 million note. It's performing, but it matures in 18 months. The bank is willing to let it go at a discount because of several factors. One is 40% of the tenant's lease expires within the next 6 months. And the owner does not have commitments. And the largest tenant in the building, we're hearing, already said they're not going to renew. So when you think about that, now their revenues are going to drop. The loan was written at a very low interest rate as well. So the bank right now is getting funds at a very low interest rate that's going to be maturing. Like I said, as of today, equity in the property, but if they do lose 25% of the tenants, all of a sudden that property now will probably flip upside down. So I give the bank credit in this instance. They're being proactive to try and get this debt off their books. On the same token, investors who are looking at this debt understand the situation and are already pricing in that price damage accordingly and assuming what is going to happen. The other interesting thing that we've seen recently is a small office complex, 2-story kind of building on a main road, approximately 15 to 20 tenants. This place is 95% leased. It's worth approximately $2 to $2.5 million. Great location, great mixed tenant use. There's not one tenant that takes up like a huge amount of space. The owner has a $600,000 loan, so 30% LTV on a $2 million valuation. Loans maturing, the bank will not refinance them. The bank just is not willing to refinance office. I've heard about this on 2 other phone calls I've had with people that I've worked with in the past who own office buildings. They are struggling to find or get refinanced on these opportunities. And people ask, well, why is that the case? Well, let's go back to COVID and work from home. A lot of companies now are downsizing their office space and, on that work from home environment and allowing people to work from home or certain staff to work from home or reducing office space because they're going to do shared offices. If people come in 3 days or 2 days a week may share the same space, kind of like an open, almost like a WeWork style office within that office for people to share because that will reduce costs significantly. So between the commercial side of things, bringing this full circle, we've got several major impacts going on. We've got lack of people going back into the office space shrinking. We've seen in Silicon Valley what's happened where, I forget the names of the companies, but they're giving $50 to $100 million buyouts to the owners of these buildings to get out of these leases. Between that and the interest rate increase on these short-term loans, it's causing significant, or it's looking like it's going to cause significant financial harm in the space. And, again, we're just talking office retail. If we talk multifamily for a minute, this is, another interesting segment. An article just came out, I think it was Bloomberg. Multifamily sales are down 74% in the first quarter of 2023. 74%. Let that sink in for a second. And people will say, well, why has it gone down 74%? Well, there's several factors. One is, like this foreclosure that we talked about earlier, that was bought at a 4% cap rate. And cap rate is basically almost like the interest rate that, your rate of return on that asset, until you try and, liquidate it, or what you'll sell it off of based off of NOI. It's a measuring stick. It's not not something to always abide by, but it's a measuring stick to get an estimated value. Interest rates today, again, let's say they're at 7%. Previously, you could borrow money at 3%, which is below a 4% cap. And let's say that differentiator is maybe about a 1 to 1.5 point spread. Now, if interest rates are 7%, you can't borrow money to buy a 4% cap building, because basically you'd end up probably being at like a 1% return, where again, risk-free money from the government is around 4.5%. So it's causing people not able to finance these deals, or not making sense to them to buy these multifamily deals until those cap rates start to go up. Cap rates in the first quarter of 2023, I believe, went up 0.3%, or 0.3%, which, 30 basis points is significant and potentially the largest, again, that they have on record. And, the theme that you keep hearing is, in this discussion, these swings that we're seeing are historically the largest we've ever seen. So people think that we're in a safe, cushiony spot. I can't predict what is going to happen. The government intervention can impact a lot of things, but we are seeing some major swings. We saw that during COVID, where things went up significantly because there was such an insurgence of money into the economy. Now that's getting sucked out. And because of the interest rates, banks and other assets are starting to get devalued based off of, the borrowing cost. We're seeing a lot of concern coming into that space. So what does all of this mean? Where is all of this going? And I think I've, kind of touched upon a lot of things that within this episode of my opinions, kind of what I'm seeing on real estate side of things. Residential real estate is really down to an MSA, and not as big as macro. But from a macro level, banks have less money. We have less inventory. Credit is tightening. For me personally, I'm not seeing a significant increase in home prices anytime soon. I think we are going to see softening on prices because of several factors. One, real estate is lags the market by easily 12 months. You go back to 2008, that downturn, real estate's lowest prices were in 2010 and 11. Based on the interest rates where we're seeing them today and not expecting them to go down significantly in the rate of inflation and job loss, I think we're going to see a significant increase in distressed debt coming on the market. We're at all-time lows today. I don't think we'll get to the percentage of the rates we were at in 2008, but historically the norm is around 4%. today, because of COVID and everything else, we're at like 1.7%. If that doubles, even though it's still going to be at an average, it's going to shock the system on the residential side. Other components that impact that are rent rates. Rental rates are starting to soften, like we mentioned on this multifamily aspects. You can check multifamily is starting to soften on the rent rates. That will go back and impact the single family. The other component I think that's going to impact the residential side is the short-term rentals. We had a significant uptick in certain markets on short-term rentals. People who got in early should be okay. People who got in later and were banking on returns from 2020 to 2022 potentially could see some trouble there, because again, if they start going cash negative, there is not going to be much options for them to refinance. So that's the residential side. And again, on the commercial side, which I do believe has a significant impact on the overall markets and the banks, pay attention to what is going on. We've seen several bank failures. Recently, there was a report, I believe it was BlackRock, has $90 billion in loans to sell from Signature and a few of these banks that ended up going under. To give some clarity, in 2008 crisis, BlackRock was responsible for selling approximately $130 billion of assets. And we're just at the start, and there's already $90 billion that they're going to have to start. And many people think we're just starting to peel back that first layer of the onion. So hope people don't think this was a gloom and doom episode. I think it's more meant for people to, if you're investing in traditional real estate, do a little extra due diligence. Look at some of the alternatives. And like I said, we are in the note space, and we do believe this is going to be an opportune time for us as note investors, because if you ask people out there, every major news or institution is predicting distressed debt to increase. And looking at alternative investments that do not take on debt structure and, basically use the equity from the investors is going to posed to be, I think, a much lower risk compared to some of these other opportunities like the multifamily deals, which 4 years ago you may have been able to get 15% yields on those returns. But now we're looking at, for example, this foreclosure. These investors lost everything, 100% of their money. And to rub or add salt on the wound, a lot of people like to invest in multifamily because you get all this depreciation, including bonus depreciation. Well, in this situation, from what I read, and I am not an accountant, I'm not a CPA, but I thought this was very, very interesting, was they took that bonus depreciation like in year one. But because basically they went under, they have to give that bonus depreciation back. So what does that mean is, on your K1, you took extra depreciation, which gave you, basically a tax, a better tax analysis. So you probably got money back. Now you have to go give that back. So not only if you invested $100,000 in this investment, that $100,000 is gone. Now you're gonna have to actually go back and give money back to the IRS as well. So, people don't talk about these things pretty often, or don't talk about these risks. People a lot of times only talk about that upside that people can see or go through. But we're really starting to see issues and cracks within the markets. And I want to come on and share that for people, because I thought it was an important thing to discuss with investors. Again, some of the things that we're seeing in real estate, whether it's commercial, residential, in that note space as well. So hope you enjoyed this episode of Creating Wealth Simplified podcast. Hopefully you enjoyed it. And as always, please leave us a review on your favorite listening station. Thank you all. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.